Okay, I'd like to welcome everyone to this presentation. This was actually an updated version of one we gave live last week to the Invest Advisors client family. Basically from popular demand, they asked that I re-record this, update the numbers, and share it so that we might also have those clients who did not attend or could not attend. And also there are folks who want to share it with friends and family. So I'm happy to do this presentation again. We've updated the numbers today as of Wednesday, March 18th. And we'll go through this as quick as we can. It runs about an hour to just about a few minutes above that. But now that it's recorded, you can start and stop as you need to. If you would like to have these actual slides as a PDF, you can also email me and I give you that information at the end. And I'm happy to send you the slides, okay? So let's get started. But this is about the coronavirus, what it's doing in the world stock markets and to the world economy right now. And I wanted to dispel some of the media hysteria and some of the partisan spin that you get from both sides of this political hot potato, really, and show you not only what's going on, how long we think it'll last, and also how the markets will respond once we're kind of through the tunnel of this particular thing, okay? A couple of quick disclaimers, though, before we begin. Nothing in this presentation is intended to be a solicitation to do business with Invest Advisors. We are registered in specific states, and we have pretty specific criteria that we use before we will do business with a client, okay? So I think that's the most important thing for people to realize is that we are not for everyone. We're for a lot of people, but we'll take that as we go. If you need an investment advisor and you're in a state we're licensed in, more than happy to talk to you about it, but that's not the purpose of this presentation. Nothing in this presentation also is intended to be a specific investment advice or recommendations. This is not Mad Money on CNBC. This is just information about the coronavirus, about how stock markets respond to panicky situations, and that's it. So we do not also provide investment or financial advice without a signed client agreement. So in no way is you watching this constitute me giving advice to you if you are not a client, okay? You just enjoy this presentation, hopefully for educational reasons. I said entertainment because that's the legal word. I don't think anybody's entertained by what's going on. But anyway, there you go. We're registered again in Colorado and Texas, and we'll give you some contact info if you do have questions at the end of the presentation. Here's what we're going to cover, and I'm going to do it as fast as I can still do it well. We're going to cover the most recent medical news out of the World Health Organization and the United States' Centers for Disease Control and Prevention. We're going to look at current market conditions. I'm also going to show you some previous market corrections and how they played out over time, just to help give us some perspective and help keep our cool. We're going to talk about beating the odds of this particular infection and panic that comes with it by using some principles called behavioral finance. And then we're going to be just telling our clients what we're doing here for you behind the scenes, and actually talk about, is this a potential buying opportunity for the right people? And then, like in the original presentation, we took questions. We're not able to do that here, but I'll give you some ways to get in touch with me if you have specific questions, okay? Let's talk the recent medical news. We know this virus originated in China. It was given its name finally in January of this year, January 6th to be specific, but we now know we have cases going back in China all the way to October 2019. They do not know who the very first person to have this virus is. That's still of confusion to a lot of people in the medical community. And that's important to know where it originated so that we can know where the virus, if it came from, for example, an animal source, where did it come from? They're still figuring that out. There was some speculation because coronaviruses do travel in bats, and they do believe it came from a specific food market in Wuhan, China, but they don't know for sure. That's still purely speculative at this point. We know the virus is not terribly contagious or deadly. It is more contagious than many of the common ailments we see at this time of year in North America, and it is a little more deadly so far. But it is not by any means, the anthrax or something significant. We'll go over that. The virus is apparently looking like it's affecting older populations at much higher rates than people under 60, but we are finding out now as we do much more testing here in the United States that the significant number of younger people are actually the ones that have it. They just don't have symptoms or very mild symptoms. So that's actually news today that we're finding out that the vast majority of our infected people are young people, and that's what some of the risk is and why we did so much of the lockdown that we've done. It is media hysteria, not so much yet the virus itself that's behind much of the market declines. Now that we've actually some of the states have taken really extreme actions on curbing the opportunity for the virus to spread by closing restaurants and bars and that kind of thing. Again, because that's where the younger populations are hanging out. So we're trying to actually help the millennial audience not spread the virus. That is going to impact the economy somewhat, but we are seeing significant action by the federal government and the state governments to counteract that. And I actually have high confidence on two things, and I'll explain through the presentation. One is that this virus will be contained in short order. I think we're doing an extraordinary job, taking extraordinary measures to do it. Yes, putting a dent in our economy, but the federal government is also in step 2, taking extraordinary measures to keep the economy humming through it and then get it roaring right after. So we're going to talk about that again in some detail. Also, we now know the virus is declining rapidly in China and Asia. New cases in China have basically gone to nothing. And the same thing with South Korea. And we'll show you some of those numbers. And also the good news is, as we're doing more testing, the death rate is dropping everywhere in the world where this particular virus has taken grip. And we'll talk about that a little bit more in detail. So let's first talk about how severe this virus is. As of now, as the symptoms are showing, this particular graph, by the way, and several I'm using, is from a wonderful website that does infographics about all sorts of things, called informationisbeautiful.net, and they update these things constantly. So feel free to even keep track of these particular graphics on your own if you'd like. But here we go. The majority of infections, if you do get coronavirus, are mild. 81% of all cases of every age right now are treatable with just your usual Mucinex, staying hydrated, taking some Tylenol or ibuprofen for a fever to kind of maintain the fever, staying at home. And the best thing you can do in the vast majority of these cases is just isolate yourself. Do not spread it. This will help this virus eradicate quickly, okay? For about 13.5%, just barely above that, these symptoms become severe enough that you need some hospitalization. And that could mean something as simple as fever control to something as serious as a ventilator. And so that's where that is something we need to keep an eye on for those folks. 4.7, so under 5% of cases become critical, where you end up needing intensive care and life-saving measures. And still, even with that level, the death rate for that is about half of those people, okay? Now, who is most at risk of not getting the virus, but who is most at risk of really suffering a consequence from it? The vast majority of us, the vast majority, including the largest segment of our population, which are millennials, are almost completely unaffected by this virus in terms of their health. That's not the worry. The worry is that you guys are good spreaders of this virus. So we are trying to protect the older populations as much as we can, the ones more at risk. This particular graph shows, for example, that there have been 0 deaths of children under the age of 10, none. And from the age of 10 through essentially age 50, the death rate is about the same. You're 99.8 to 99.6% of all cases of this virus survive and recover completely. It starts to bump up a little each decade after starting at age 50 though. We're at 1.3% fatality rate in the 50s. It basically doubles up to 3.6 in the 60s, then 8%, then 14.8% in your 80s. But folks, let's keep that in perspective. 14.8% of people in their 80s pass away from this illness, but that also means that 85.2% don't. So even if you are in your 80s and contracted coronavirus, you still have better than an 8 out of 10 chance of beating this virus. Now, we're not saying that that's nothing to, we're not saying that this is not something you should be concerned about, and we should definitely try to protect our loved ones. But we just need to make sure we keep our wits about us. This is, for most people, a nasty chest cold. For a few that are especially in high-risk categories, this could be fatal as other diseases like the flu or pneumonia could be. In fact, let's take a quick look at that. Now, if we take age out of the equation and we just look at those people who had serious other health conditions, we find out that no matter what age you were, 10.5% of people with heart disease passed away from this illness. 7% of people with diabetes, chronic respiratory disease, 6%, about the same for abnormally high blood pressure. And then cancer actually was only about 5%. But if you take out any really serious health conditions, if you were in generally good health, at any age, the rate of death was less than 1%, okay? And let's take a look at also keeping it in perspective about figuring out where does this virus sit in terms of the other viruses and communicable diseases in the world and how it kills us every day. So here is a look at the average disease deaths worldwide every single day on this planet. And this was updated as of a couple of days ago. By far, the #1 killer in the world of infectious diseases is tuberculosis. It kills about 3,014 people a day. That is just barely more than half of the total deaths worldwide from this virus since it began. Hepatitis B is there, pneumonia, you can see HIV, AIDS, malaria, the swine flu from 2009, the norovirus, whooping cough, cholera, meningitis. Then you get to measles and even rabies, and rabies kills about twice as many people per day in this world as the coronavirus does. And it sits right next to yellow fever and some parasitic infections that are found in third world countries. And then you get all the way down the list to, sleeping sickness, chickenpox, hepatitis A. So guys, let's keep it in perspective. Yes, it's serious. Yes, it's communicable. Yes, we can beat it, but it also is nowhere near the fatality rates of other illnesses around the world, okay? So look, how contagious and deadly is this thing? Well, we don't know fully yet, but we do know it's gonna fall into this range of this orange box. Now, what this particular graph shows us is we've plotted out a number of different, very common communicable diseases around the world, especially in the last 30 years. This vertical line shows what percentage of people who got that illness passed away. Okay, so we can look, for example, at Ebola. About 50% of people who get Ebola pass away from it. So it's a very, very serious disease, and when we see it rear its head, we go really aggressively to try to stop it where it starts. Now, the bottom line is the average number of people who get infected by one sick individual with a particular illness. So as you can see here, Ebola, 50% of the people who get it pass away from it, and it infects about 2 people for every 1 person that if you have Ebola, you're going to pass it on average to 2 people, okay? We don't know yet exactly where the coronavirus is going to fall, but we do know right now from every worldwide statistic and as every nation starts dealing with cases, it's falling inside this particular range. So in the worst places, about 1 person is infecting 3.5 others. That's what we saw in Iran, Italy, and China, and also, frankly, the nursing home in Washington State, which accounts for just roughly half of the US fatalities right now. And then the fatality rate has ranged everywhere from 0.7 to 3.4%. That has a lot to do with how developed the nation is, how quickly the government stepped in to take action on it, and the age and relative health of the populations involved. So it's going to end up somewhere in this box. But as you can see, for example, the norovirus, 1 person gets about 8 people sick. Measles, 1 person infects 9 other people generally. These are very, very communicable, contagious diseases. This is where the COVID-19 virus is going to fall, okay? So let's look at, and by the way, the fatality rate varies significantly by country like we talked about. And that includes statistics like the age of the population involved. For example, Italy has taken a huge, huge number of deaths in this particular virus. In fact, they have the highest death rate in the world of 7.3%. What people don't really hear that often in the media is the average age of a person passing away from this virus in Italy is 81, and Italy has the oldest population in Europe. So that was one that Italy did not take action soon enough. The virus spread quickly into the elderly population, and we had a high death rate. As of a few days ago, the United States had a 1.8% fatality rate. And there's some updated numbers as of today when we're recording this. We actually, now that we're doing so much more testing, we're finding the number of cases in the US is really ballooning up. And that's one of the reasons for the containment that the government has done recently. But the number of fatalities is only just trickling up. And unfortunately, of the 115 fatalities as of today, 55 of those were in Washington state, and almost all of those were from one single nursing home where this virus got loose. So we had an elderly population already very ill with other issues, and unfortunately it wiped out a large portion of those affected people. So our hearts and prayers definitely go out to those family members and anybody of the 115. But folks, as this number explodes, like the other day on the 13th of, 2 days ago, we had 3,800 cases with 70 fatalities. We've nearly doubled the number of cases. Fatalities has only crept up by 55. So the death rate is definitely slowing, even as the case rate is ballooning. And that's very, very good news, by the way. The fatality rate in the US a week ago was 4%, because most of those deaths happened in the nursing home in Washington. It is now 1.57% today. Okay? And here's the good news. Let's talk about a little bit of good news. The vast majority of people not only do recover, but they already have recovered. 56.6% of the people worldwide that have contracted this virus as of March 9th have fully recovered from it. In China, all of the 16 makeshift hospitals that they set up have now closed. Life has returned to normal for most of Wuhan, China. The virus is over. It's passed from them. Unfortunately, now the wave is going through our country, and we're doing what we can to slow the rate of infection. 40% of people worldwide are still currently ill with it. Doesn't mean they have very serious symptoms. It just means they're not testing negative yet for the virus when they do blood tests. And then 3.5% globally have passed away. Again, a great number of those happen to be in just a few affected countries that did not respond quickly enough to this. But recovery is happening. This is a chart that's updated regularly at Johns Hopkins University's study for their science and engineering college. But we can see that the orange dotted line was the number of reported cases in China. And it took a jump as testing got, more testing happened. But China then really locked down, took very drastic action to isolate that particular community. And as you can see, the graph slowed way down. And this is not new cases every day. This is total number of reported cases. So China flattened its curve very substantially to where there's now essentially no new cases every day. The green line is the number of worldwide recoveries. And again, not a daily count, but a continuous count. So we take this number, we add to today's recoveries, the number bumps up slightly. You can see now that the number of recoveries has surpassed the total number of cases in China. Essentially, China has fully recovered from it. The yellow line is every other place on Earth combined in the number of cases. This exponential jump is actually not new cases, like the infection is spreading like wildfire through our populations right now. We are now testing regularly and getting more and more tests out. So honestly, this graph could probably have shifted back here quite a ways, because we had people that were affected and infected that had no idea, that they thought, like I've been dealing with allergies for about 2 weeks now. I think it's allergies. I have no fever. I don't have any of the classic symptoms. But a lot of people might have thought they had a little bit of a traditional common cold, a little bit of the flu, like we're in the season for it, and just never went to the doctor. They just managed their symptoms. Those individuals could very well have been coronavirus carriers and not known it. So now that we're doing widespread testing, this number is going to spike up significantly. Okay? And what the government is implementing right now, and what they're trying to do with all of these drastic actions, making us all stay home and binge watch TV, for example, is because we're trying to flatten out the curve, the rate of infection. The reason for that is there's this dotted line that runs across here. It's just a representative sample of a country's ability to handle hospitalizations and very sick people. So let's call this their healthcare system capacity in each country. What we saw happen in Italy was they did not take preventive measures, and the virus went nuts in Italy very, very quickly. Okay, that causes a high fatality rate because you'll end up with more patients than you have the ability to medically care for them. So what our government and many others around the world are now trying to do is slow the rate of new infections so we can keep it inside the ability of our healthcare system to effectively manage it. This will make the virus last a little longer, but the death rate will be substantially better than if we just let it take its course and run itself out. So some of the protective measures they're talking about with us is, and they say, don't panic, be careful, wash your hands a lot, don't touch your face. The eyes, ears, mouth, nose are all open entrances into your body for the virus if you have it on your fingers. And stay at home if you're sick. The governments are taking very fast. It says widespread testing is what they really need to know how many we got. So they're really working on that now. They're trying to limit large gatherings of people, and they're trying to watch infectees as they've already been infected to see the cure rate and see when this particular graph will slow. Folks, it worked in China. It has worked in South Korea. It has worked in Japan. It is working now in the United States. We'll see that soon. And I think we're going to come out of this just fine. Okay. Now, I'm going to start to shift from what is going on with the virus to why is the virus so amazingly impacting the market. And although this is not an indictment of our media, because the media has got probably like a once in a career kind of viral outbreak. So these reporters and news people, this is new to them too. But there have been an extraordinary number of mentions in the media about this virus, which is what I believe caused so much of the panic buying, the market, serious market pullback before we really had any data to work on. There have been, just as an example, these blue dots are all of the different communicable viral diseases and how many times they have been mentioned in media. So for example, the next most mentioned virus in the media has been HIV. It's sometimes easy to forget that that is a virus that runs through us. 69.5 million mentions in the media. The coronavirus, though, has already been mentioned since January, 2.1 billion times in media. That oversaturation of coverage for a virus that at the moment has killed 115 people in a country of 350 million is what's done most of the damage in terms of economics, the stock market, the panic buying, etc. It is the media oversaturation of this virus. And that's one of my most important jobs for you is to help keep that in perspective, okay? So here's what we can know with comfort. Pandemics always have a life cycle, okay? Most of them are seasonal. You need close proximity to spread many of these, including the coronavirus. We don't know exactly how communicable it is yet. We actually have conflicting data on that, but we know that in the summertime, we are generally not cooped up in office buildings, breathing the same air with people. You need close proximity. It's one of the reasons that, they asked you to stay away from unnecessary air travel or train travel, bus travel. Don't sit in a movie theater right now, which is why they closed them. Bars and restaurants are great places, people handling dishes together, sitting right next to each other in a bar. It's just an easy way to spread it. So the actions they've taken will help that out dramatically. Pandemics generally fade out naturally in warm weather, just for exactly the same reason. We're not cooped up, we have better air circulating, we're outdoors more. It's just generally, we see a significant decline in these kinds of illnesses until winter months come again, okay? The vaccines and effective treatments will usually happen within just weeks from an initial outbreak. It's happening in this one again too. In fact, in record time, we'll talk about that in a second. And in viruses, once they are emerged onto the world scene, are generally contained and well managed within 12 months because by then we've created vaccines and we have effective treatment options, okay? So let's take a look at an actual life cycle of the last major, and by the way, the fastest in history, pandemic, which was in 2009. It was the swine flu. Most of us are old enough certainly to remember 2009. I don't know how many of us remember this particular pandemic, but it happened. The reason that these things now move so fast is because of the internet, the speed of technology, and that we have every major medical institution, every scientist, every academic in the world able to work on the problem together. And so you'll see, and I'll just kind of run through this very quickly to show you, the normal life cycle of a pandemic in the 21st century. We're not talking about 1918 Spanish flu anymore. We have so many more resources. These things move very quickly. So from the first day there was an infection detected, by the 7th day, work had already begun on a vaccine for the swine flu. By day 10, the entire DNA strand, the entire genetic code of swine flu had been mapped and was published free online, so the world's universities and scientists and corporations, pharmaceutical companies could begin work immediately. By day 11, 10 days later, a public health emergency was declared. We have a new virus and it may spread. By day 14, there was now a test to able to detect infections, and it was released. The test shipped globally 3 days later, but in the meantime, we declared a pandemic was going to be imminent, okay? Then we're starting to shift in from days to just a few weeks. On day 58, the number of cases had grown substantially worldwide. A pandemic was declared. By day 72 of the swine flu, there were 1 million cases of the swine flu in the United States. By day 99, we already had a vaccine. The vaccine was ready for clinical trials, and they began using human beings as guinea pigs for this vaccine to see if we got one that would work. By day 142, so about 3 months later, we were up to 477 child deaths in the US from swine flu. There have been 0 child deaths so far because of the coronavirus, different virus completely. It's acting more like chickenpox, which was really not a major thing for kids, but a major thing if you get it when you're old. So it's sort of that kind of approach right now. By day 154, though, 4 different vaccines had been approved, and we started vaccinating healthy public populations at day 174. Day 216, a 5th vaccine was approved. By day 231, we concluded the trials of vaccine results, and it worked. Things were great. By day 260, there were 100 million vaccines available worldwide, and were in use in 50 countries. And that's really the last you heard of swine flu. So people have asked us, where are we kind of in relation to this timeline for the coronavirus? Right now, as of today, we are on day 77. Clinical trials of vaccines began on day 72. So we're about 3 weeks earlier this time than we were for the last fastest in history, which is the swine flu in 2009. Folks, we're moving along at record pace. There's also very promising news coming out of the FDA that there may be some existing antiviral drugs that are having a wonderful effect at reducing the severity of the infections once we have it. I'm actually waiting for that news conference, hopefully tonight. President said tonight or tomorrow morning, but that could be a major substantial sigh of relief for the world, that we may have some treatments that may rapidly diminish this, okay? Now, just like a pandemic has a life cycle, so do investment markets. And we're going to talk a little bit today about what causes investment markets to move up and down when you're not talking about company profit or the development of a new product or anything like that. When the stocks just fall, those are always emotional reasons. And so, in my business, there's a field of study called behavioral finance, and it talks about how human beings think and act and feel and make decisions about money. And most of the time, we are affected by what are known as about 30 different cognitive biases that we all have built into us because we are humans. And we do have emotion attached to our 401k balance, and those emotions cause us to make wrong decisions a lot. Okay? What behavioral finance, and especially when you piggyback it onto studies of stock market cycles and watching actual charting, those kind of things, is we learned several things over the last several decades. Number one is individually, human beings are pretty unpredictable, but in large groups, we are extremely predictable, amazingly so. And we also know, because we've actually watched investor behavior when markets do certain things or bad headlines come up or we go through economic recessions, investor behavior during difficult markets is always irrational in the moment. We now know that, but we also know that it is extremely easy to predict what the reaction will be. Okay. Now there are, like I said, about 30 different cognitive biases that we study in behavioral finance, but the 3 that I think are most at play today are recency bias, which means that You believe that what's happening right now has to be so much worse than anything that's ever happened before. Or when you have really good times, the same thing. I've never felt better in my life than right now. But most of the time it's a negative that people feel. First of all, we feel negative things more, if they're more impactful than positive things feel good. But we also believe that anything happening to us right this moment is emotionally more impactful than many worse things that have happened to us in the past. So sort of just the old saying, time kind of heals all wounds. The same thing applies with recency bias. What's going on right now feels like the worst thing that's ever happened, okay? Confirmation bias is really prevalent in our world now because of the internet, social media, the prevalence of like TV channels. What confirmation bias means is we all have certain beliefs about the world, and that could be your political beliefs, your religious beliefs, your financial beliefs, whether you're just generally an optimist or a pessimist. And we have the ability now to seek out news sources and opinion pieces and talk radio shows and Facebook friends that always confirm what we believe to be true. And we generally do not like, to the point where we will get rid of out of our lives, opinions that challenge ours. So confirmation bias is the idea that if I believe that, just theoretically, the stock market is going to crash and this is the end of the world. Let's say you really got somebody that thinks, oh, here's one. Let's say you think the earth is flat. You can find YouTube videos and websites and very articulately written columns that will confirm your view that the world is flat, and you will resist, to the point of sometimes extremism, any idea that the earth is round. So that's a really good example of confirmation bias at work. But we're all guilty of it. There's a reason. If your political orientation is conservative, I bet you watch Fox News. If your political orientation is liberal, I bet you watch CNN or MSNBC. I don't think, and you will not like the other channel, depending on what your perspective is. You'll think that they're biased, but your channel's not biased, of course, but the other guy is. And that's very, very common confirmation bias. The other one is called the bandwagon effect, which is, we can also call it the mob mentality. You might have heard keeping up with the Joneses. This means that human beings do what other human beings are doing. So if your neighbors are painting their house, this is a really weird phenomenon. One of our neighbors painted their house last spring. By August, like 7 of us painted our houses. When one person is panicked about something in the news, more of us will get panicked. We do whatever the herd is doing. If the herd is out buying new cars, we want a new car. It's just the way that is. So that's one of the other biases that are at play right now. So it's also important for you guys to understand this. Market cycles are completely normal. And that's because you have, going to the stock market every day, a certain number of optimistic people looking to buy stocks and a certain number of pessimistic people looking to sell stocks. And that battle of how many of each one of those shows up each day is what the up and down movement of the stock market is, okay? I will add one other caveat to that, which we'll get to in a minute, but what you have, and we can see this throughout time, this is a graph made long before this particular virus came about, but this is a very normal thing. You have times when we've reached the bottom of a market cycle. Basically, all the sellers have exhausted themselves. Buyers are waiting for good news to see if it's a chance to get in and ride the stock back up, and they start to buy. As they start to buy, more people, because we're herd animals, start to go, oh, my neighbor's buying stock, maybe I should buy stock. And we ride this particular thing up, usually a little too high. You might have heard that referred to as a bubble, or just the market is overbought right now, okay? Then you'll get to where some people go, oh, I think maybe this is time to start getting out. The market's gone up for a long time. So they start selling. What we find out is other people start selling too, because their friends are selling. They start to see the stock market go down, more people pile in. It creates this area where there's a little bit of battle again, buyers and sellers, but eventually you will exhaust the number of buyers. The number of optimists will be exhausted. Now it's the seller's turn to drive the stock prices down. And the more people sell, the more other people sell. It's the herd mentality. It goes down. okay? Now, not only are market cycles normal, but your emotions during those cycles are perfectly normal too. And in fact, they have been, it's so common that we've actually now been able to basically pinpoint where we are in a market cycle based on how you feel about it as an investor. So if we get a lot of investors' sentiment, is what we call it, we can find out where we really sit, excuse me, in terms of a market correction. So let's say we're kind of in the middle of the road, but the market's been trending up. We generally find optimistic people. I know in my own practice, you know, as we start to really get higher, I have my more conservative clients call me and say, I want to take more risk. I want to take more risk. And this is usually because we're reaching the top and everybody's euphoric thinking this is going to go up forever. Life is great. And I'll usually tell you then it's the wrong time to get more aggressive because you've missed it. You need to be aggressive at the bottom of a market cycle, not at the top. Okay. So when we get up here, you are actually at the point of most of the maximum financial risk, but that's when you're going to feel best about it. Okay. And then as the market makes a correction, like we've experienced, this one really was more like a cliff. It just sort of fell off. But in this case, we're starting to go down. You start to see some anxiety, some denial. We get into some fear. Then we get into desperation. Then we panic buy toilet paper. Okay. And then we get into capitulation, just means surrender. And then despondency, this is never going to get better. Then we get into some depression. And then, the market seems like it's recovering. I have some hope for the future. Okay, maybe this is okay. And we go up. It is at the point of maximum depression that you actually have the greatest chance for long-term gains in the stock market because you're buying stuff that nobody else wants at the moment, which means you're buying stuff very cheaply. That's really important. And because we've seen this cycle play out over and over and over again over the decades, we can generally pinpoint where we are in a market cycle based on how the investors are feeling about it right now. Now, I have just purely my opinion, but based on my own clients and talking with other financial planners and just looking at the general investing world, I believe we are somewhere in here right now for this particular cycle. I don't believe it's ready to snap back up immediately yet because we don't have concrete data about this virus's tenacity or about the total impact it's going to have on the economy or what the government stimulus programs will do to help keep it up. But based on your emotions, I think we are near the bottom, and then headlines are just going to slam the stocks up and down for a while until there is legitimate reason for hope. And because this stock market fell so fast, so quickly, I believe much of this recovery will actually snap back as well. We're going to show you why that is in a minute, but let me actually show you, give you some perspective on a market correction. If you were invested in 2018, 2019, 2020, you went through this particular chart. You may not remember it because usually, again, recency bias means the stuff that happened in the past fades in significance to us emotionally, okay? But this was July through Christmas Eve in 2018. The market reached a high, and then we started doing some trade negotiations with China, and everybody was afraid that the trade negotiations were going to crash the economy. So investors started selling sharply, and that caused other investors to panic. And then there was a group of us, I was part of this group in the financial planning world that said, guys, there's no good economic reason to sell. This is just fear of something that hasn't happened. So we kind of rallied back up. And then sure enough, we had more news. The tariffs were going to kick in. It spooked the markets and we crash landed about 20% down from where we started in July on Christmas Eve. I still remember I had clients calling me on Christmas Eve, very scared. What should we do? And I said, there's no economic reason to sell. This has to snap back because the economy is doing fine. So let's take that graph and pull out and see what happened after that. So here's Christmas Eve. And again, we find out, no, the economy actually were not hurt by those trade negotiations. Trade negotiations sounded like they were going well. The stock market snapped back up fairly quickly. And within just a couple months, we were back over our high. Life was good, okay? And then you see that we have had since then several dips that have recovered. This is the big one we're in right now, okay? It's a steep one. but it's also almost a vertical line down. That is not based on analysis or actual companies reporting profit changes, anything of the sort. This is purely based on emotion and speculation. So let me also then take this graph and expand it out to 5 years. Now here is your original graph in that original fall. And you can see that we had a long run up. This is in July of 2015. Long run up, nice and smooth. We started to see some jagged stuff, corrected, started to see some jagged stuff, and here we are today. So over 5 years, we're way still ahead of where we were 5 years ago, okay? And that's important to keep in mind. But there's something else I want you to notice too. If you notice back before the most recent volatility, when we had a downturn, it was more U-shaped in the market. Very nice, sloping, gentle, much more deliberate thought process going on, looking at actual company reports, looking at economic indicators. Things were just sort of slowly meandering their way. These sharp V's are not U's. They're sharp, jagged V's. These are headline-driven, emotional decisions that don't have any basis in reality. And the reason we know that is because they V down and V right back up, and they usually end up higher than they were before. Okay, that was not the case here. Nice and smooth, and then off we go. Okay, guys, these are emotional, headline-driven market corrections. These are more deliberative, based on actual company profits and economic forecasts. Very, very, very different. This one is the sharpest V probably we'll see in history. We'll see how this goes. Okay, so here is why I believe this very deep V is going to snap back quickly. Number one, our economy has never been stronger. That's objective. Okay, that's not political spin. We have a great economy, and we did before this. So basically what we were is, let's say we were on an elevator and our economy took us to the 10th floor of the building. And let's say then the coronavirus hit and we fell to the 7th floor. Okay, guys, that's not a fall into the basement. We weren't at the middle of the economy. We weren't on the 5th floor when this happened. We were all the way at the top of the building. So I do believe that the strong economy will continue. We just have to get past this virus as quickly as possible, okay? I also believe because medical science is hard at work globally. There are already new treatments they're trying. The vaccine is there. One vaccine at least is already in human trials, fastest ever in history. So we're moving along. Medical science is going to beat this thing quickly. Also, the reason, one of the other things is because companies have inherent value, regardless of our emotions at the moment. I'm going to really dig into that point in just a minute. And finally, life continues. Yeah, we're kind of disrupted right now, but you can still go get your Chick-fil-A. You just have to drive through. You're going to still fill your car with gas, and fuel prices are very low right now. That's good for us. The government is going to stimulate the average American with a check and reducing taxes, burdens, and giving loans to the businesses to keep them afloat. Life's going to continue, folks. I believe we'll recover just fine. Now let's talk quickly about the first bullet point. Why is the economy strong, or why should I say that? One of my favorite tools when I look at making decisions about the investing strategies we use here at Invest Advisors is we'll take into account market conditions, but market conditions can change moment to moment. As you guys can see from the last 2 weeks, we could be up 1,500 points in a day or 2,000 points in a day, down 2,000 points, up 1,500 points, down 900 points. So those strong movements are things we cannot predict. And I certainly would not try to take you guys on a roller coaster ride of guessing through that. So I look at economic reasons to make changes to your portfolio, because economic reasons are very slow to recover usually. It takes a while. You can't close down a bunch of factories and then just open them up again a week later. You have to, there's a layoff process, there's a rehiring and a training process. It takes a lot. So we look more at economic things than I do market things. The Russell Economic Dashboard is one of the coolest and easiest to use charts that you guys can even take advantage of yourself. If you do a Google search for Russell Economic Dashboard, anybody in the public can look at this particular graph. They update it regularly, and it's easy to read. And to me, this is one of the simplest ways. I've used this for years and years in client presentations to show you what's going on in the world, and every client's given me great feedback on it. So the economic dashboard looks at 4 market indicators. This is where the stock market is generally headed. And then we have 4 economic indicators, and this is where the economy is headed. So I want to show you guys these 8 indicators very quickly, but let me explain how to read this particular graph. For each one of these indicators, Russell has taken every point in history that indicator has ever been and turned that into a gray bar. So for market volatility, it has ever been only as low as 10.13 on the scale and as high as 62.64 on this scale. But they also know that sometimes these really weird fringy, if something's clear up here once, that may never happen again. So they say, well, what is the usual range? What is this particular index at? Where does it sit about 80 to 90% of the time? So, think of these gray ends as sort of the fringes. And the blue bar is actually where this particular number usually sits, okay? The most recent figure is in the orange box, and then the last 3-month trend, if there's an arrow above it, will tell you how that thing has been trending over the last 3 months. So real quickly, let's take a look. In terms of markets, yes, this market is wildly volatile right now. Probably this number is up here a little closer. But at the time we did this 2 days ago, the market has been sitting exactly dead center. This is perfectly normal stock market behavior historically. Now, you guys may go, good Lord, that's rough. But guys, objectively, without spin and without emotion, we are dead center perfect where the stock market volatility should be, okay? And also, it has been trending up the last 3 months, but that's to be expected, okay? The next 2 have to do with the price of the treasury bond. So when you're scared of stocks, you generally buy a bond. Investors don't usually just go to cash. They usually say, I want something safer. Well, these next 2 market indicators talk about the safety of bonds. And so what you have is the 10-year U.S. Treasury yield. A yield is the price of a bond, and taken into account how much interest. Let me say this again. The yield is how much interest is this bond giving me if I buy it, and then taking into account how much did I pay for the bond to get it. So to get a yield calculation, you say, let's say that this particular bond is paying me 5%, but I had to pay a 3% premium because there was a lot of interest in the bonds right now. So I had to pay a 3% above its value to buy it. Then the yield on that bond would be 2. So 5% interest, but I had a 3% premium to buy it. So I have to take that off, really, the interest I'm getting. And so it'll be a 2% yield, okay? Hopefully that makes sense, but let me show you what we're talking about here. The yield on a 10-year U.S. Treasury bond right now is at a historic all-time low of 1.13%. This means a couple things. Number one, the interest rates being offered by the U.S. Treasury are very low. And also because people are scared of the markets, they have demanded more of these things, even if you don't get a lot of interest. So the prices on bonds have gone up. That has forced the yield down into historically low areas. What this means for those of you who are in long-term investments is that right now stocks are very, very cheap because of the volatility, but it's the wrong time to get out of stocks because you will pay way too much. You'll get almost no yield to go safer, okay? And some people, that may still be the right strategy, but for the vast majority of my younger clients and people who have got many years to use this money, it's the wrong thing to do. And that's why we haven't done that for most of our clients so far. The yield spread just basically is this. Short-term borrowers, like if you go to the bank because you need a 2-week loan to cover payroll while you're waiting on this government's lockdown to get over with, you shouldn't have to pay as much interest as if you're borrowing money for 30 years to build a factory. So the 30-year loan should have a higher interest rate than the 30-day loan, okay? That difference between short-term and long-term bonds is called the spread. And that's what we're talking about. So the normal range, again, for the yield spread should be in the blue bar. It's historically not all the way the lowest ever, but it's low and trending lower. What this means is that there really is no incentive to get a long-term bond versus a short-term bond. The interest rates are pretty much the same, okay? So again, there's no good reason for me to find you long-term bonds or anything like that because we're getting no benefit for it. So right now, the vast majority of us, the right thing to do is to wait out the stock market. And I'll show you why that's actually really critical right now. The other market indicator is home prices. Folks, we're still buying and building homes. Home prices are creeping up slightly, just in a very healthy middle range. Things are looking good that way. So let's look at economic indicators. The economy is doing very well. Right now, inflation is at 2.32, well inside its normal range, trending up slightly, but that normally happens when the economy is roaring. Okay, when the economy is going up, inflation usually goes up with it because wages are going up, therefore prices can start to increase on product. Okay, unemployment is in historically low areas. We are at 3.5%. This will jump because there have been layoffs and furloughs because of this particular virus, but those will recover very quickly. And right now, the most recent indicator is that is consistent for 3 months. I just skipped the last one, I'm sorry. The other one, let me go back. I hit the wrong button, guys. I apologize. Okay, so back to this slide again. There's two more. Economic expansion, the GDP. I do believe this GDP number is going to come way down for this particular quarter. It can't not. Companies have not been able to produce product. But for the 3 months prior, this has been holding steady at about a 2% GDP. It has been as high as over 3% last year. The economy is doing fine. It's in a dead center. And once this virus gets behind us, especially with the stimulus that the government is putting in place, this number could actually be much better than it was before very, very soon. Okay. And finally, the last one was, again, this was taken before the last week or so, consumer sentiment is at historic highs and trending higher before this happened. What this meant was people had confidence in the economy. They were taking risks and starting businesses. They were willing to buy new homes. They were willing to just expand the economy, going into a little bit of debt to maybe get a luxury item like a boat or a nice car, and that will continue. I think this has plummeted in the most recent few weeks, but again, that will snap back up. And the historical trend in the last 3 months has been well off the chart positive for the economy. Okay, so here again is one of the reasons that I believe it will recover quickly. We talked about the economy being well. I want to talk to you about a concept called reversion to the mean in this business. What this means is that every company out there, let's just pick like Apple Computer or something like that. When you look at Apple Computer, they have a certain amount of value regardless of what's going on in the world. They have a certain number of product sales per year, a certain amount of profit they get to put in their pockets or give back to their shareholders. They have buildings, they have trademarks and patents, they have they call it goodwill, blue sky type thing. So when they take all of a company's assets and they divide out the amount of its, they remove out the amount of its debts, okay, you get a certain amount of inherent value. If we liquidated a company today, there's a certain amount of value in what it owns. That's called the book value of a company. And to make it simple, let's just say that we did this for a company and it was worth $10 million. And let's say that we have 1 million shares of that company's stock out in the public, okay? So $10 million value, 1 million shares, you divide the number of shares into it. That means that company has a book value of $10 per share. Hope that made sense. Now, fair market value is always something that's up for discussion among financial analysts. And that is when you take the company's basic book value, then you start to project the future onto it. So you might say, well, we know its profits are strong and probably trending higher. So for the next 5 years, if I figured out how much more profit they're going to add, you can add the extra to the book value, and that will give you a fair market value for the stock, or sometimes they call it a target price for the stock. Now that can go either way. So your target price for a stock could be above its book value, or it could be below its book value, and that's not there's no difference really, except for do you think the company's going to do well in the next few years, or do you think the company's going to do poorly in the next few years? And that's where your fair market value will fall. Okay, now that particular range between its book value and its fair market value is something I call the fundamental range of a stock. That means that the price has to be somewhere in that range, realistically, with no emotion attached to it. So here's one of the other reasons why I think the markets are going to recover quickly. Because the stock market today, for example, is down. I haven't looked at it in a couple of hours, but it was down at 1,500 points again today because we had no good headlines on this coronavirus. Has anything changed for most of the companies out there? Not really. So why would we have this massive drop in stock prices? It's pure emotion and it's speculation. And then here comes those three biases we talked about earlier. The bandwagon effect. Other people are selling, they must know something I should sell. Okay? Confirmation bias. I'm selling, the market is selling, I'm getting confirmation that my panicky view is correct, so therefore I'm right to sell. Okay? And the recency bias is this time the market can't possibly recover. Things are going to be really bad for a long time. Folks, we've handled world wars on two fronts. We'll be fine. Okay? But because pure emotion is involved, the price of a stock can fall or rise way above its fundamental range very quickly. Okay, and when it rises way up, we sometimes call it a bubble. When it falls really far, we have buying opportunities like crazy. But reversion to the mean means simply this. The markets can stretch all they want one way or the other, but because so many investors know all of this data about what's the fair price of the company's stock, this stock will snap back to that fundamental range in very short time. The market will not allow stocks to be priced incorrectly for very long. Somebody's going to recognize a bargain and start buying stocks. And that's what is going to happen very quickly for not all of the loss we've experienced, but the vast majority of it. Let me go back to this graph again, and we're going to use this again. So if I were to talk about when we get too happy in the market and we stretch the rubber band out of the fundamental range, we end up somewhere up in here. We end up in irrational exuberance, greed. Everyone remembers Greed is Good from the 80s, the movie Wall Street. Everyone says good times are here forever, and that's not correct. So a stock price will float up way up out of its fundamental range, which is somewhere over here, and snap back. Because other people will go, nope, it's not worth as much as it's being, as much as people are paying for right now. It is overbought, and we'll snap it back down by people dumping stocks, okay? But the same thing happens at the bottom. So in the middle, we have a fundamental range of what a company's worth. Anything that falls below or above that is a rubber band stretch from emotion. But because the company has an inherent amount of value, the stock rubber band must snap back. So now we're down in irrational fear, panic. And everybody's saying this time it's different, the world's going to end. No, it's not, guys, it's not. The market must snap back. And I'm going to show you two real life examples of that right now. This is Coca-Cola actually as of March 12th. I did not update that, but basically the chart hasn't moved much down here. So this serves my point. Coca-Cola is a great company to use as an example because there's very few companies on the planet more stable than Coca-Cola. Coca-Cola, there is no place on earth you can't buy a Coke. We'd have to colonize another planet before Coke would find a new market. Okay, so Coke has generally always traded within a certain range. And Coke's business model is we're not really trying to grow anymore. We're just trying to run an efficient business and give profit back to our shareholders. Okay, here was a time when we had an irrational exuberance about Coke. The rubber band stretched up, but because this is irrational and did not serve any good purpose, and it was not about the profits of Coke, it was pure speculation, the rubber band immediately snapped back into the same range it was before. Okay, so right now Coke has been trading for several months in a very tight range in this blue box. Okay, now what happened here? Did Coca-Cola stop selling product? No. Did they find out Coca-Cola's, a bottle of Coke was the cause of the coronavirus? No. Did they change CEOs? No. Did they lose a fleet of trucks? No. Nothing has changed at Coke. This is its inherent value, which, by the way, floating at about $280 a share. Coca-Cola fell 80 points to $202 a share. But did anything change at the company? And therefore, did its inherent value change? No. So the rubber band, just like when it snapped up here and it had to snap back, the rubber band down here has to snap back. All we need is for some good headlines to start coming about the virus. Okay, nothing has changed. If you've been to the grocery store, I bet Coke has a great quarter because people are buying up Coke like crazy to stockpile. Okay, so here's another good example. General Electric, as of the same day, March 12th, GE was a little different. They've had some profitability issues as some of their media companies. And they've had, there's their CEO, Jack Welch, just passed away, but the company had been all over the place, but it had been trading generally in a range. So that the general trend for GE rather was up, okay? And there have been no change in GE as of today. So the trend, if we've seen that continue, might have been somewhere between $13 and $14 a share, but it fell by half that, to $7 a share. Had anything changed at GE? No. Did anything, the same questions again. Did they sell off assets? Did something go bankrupt? Did one of their products cause cancer and now there's massive lawsuits? Nothing like that. GE was trending this way. The rubber band snapped down on pure fear and speculation. The GE has an inherent value. It must snap back. It must snap back. Folks, that's what I'm trying to tell you. And again, on both of those last two examples, these are not investment recommendations. These are just examples of companies that you all know that have inherent value and that were deeply, deeply affected by this rubber band that is irrational. But when the irrationality ends and the panic subsides, the stock must snap back. Okay? So let me just recap again. I believe the market will recover quicker than most people believe because all companies have inherent value. So stock values cannot stay out of the range of what is considered a fair price for that company for very long because people will snap up bargains. People are not going to just leave cheap stocks sitting on the table, folks. We'll gobble them up. This is why I've told most of our clients not to move money out of their stocks. If you don't need the money this month or in the next 6 months or the next year, you should stay where you are. And actually, this is an awesome opportunity to put money in. Now, will there be some companies impacted like long-term by this particular virus? I believe so, okay? Companies that manufacture exclusively in affected areas, there was about a 2 to 4 week disruption in most of those factories in Wuhan, for example. So they may have a bad quarter as we get things going again. I think now most of the Western world is going to have a bad economic quarter. That doesn't mean it's going to stay that way. And that doesn't necessarily mean recession, because recession is 6 months of down GDP, not 3 months. So we need 2 quarters consecutively of bad economic numbers before we consider it a recession, okay? I don't believe that will happen. I think the stimulus packages are going to really help. And I think this virus, just my own opinion, is going to recover faster than we are leading right now. We've taken unprecedented action to slow this virus spread. I think we're going to see that those actions work nicely, okay? Cruise ships, though, airlines, now probably hotels, and some restaurant chains that could not do delivery for some reason or carry out are most likely negatively affected in the short term. Movie theaters will be hurt here in Colorado. Movie theaters and gyms were closed. It's going to hurt profit. Probably they may have kind of a lost 6 months or a lost year in terms of their stock prices, but that means they may be good long-term buying opportunities once we get to the other side of this, okay? But some places are going to do great. Consumer staples like food, Tyson, Coca-Cola, Pepsi, toilet paper for sure, healthcare companies, 3M that makes like these face masks that everybody was buying even though they don't help. They're all going to show a great quarter this year, guys, okay? Also, this was the president's speech way back, and I should have taken this slide out, but just very quickly, clients had questions about the president's speech when he restricted travel to Europe. It's very, very critical because Europe did not take this seriously until it was pretty well widespread. So he put travel restrictions to Europe that does not affect cargo or trade, so the products can still come over, but we're keeping the people out. Just as an update, we have also mutually agreed with Canada to close our border with Canada as well, to isolate and restrict travel. We're just going to do that. And probably you'll see that there may be limited restrictions to individual countries going forward once the major pandemic's over. If these countries are not containing their virus the way they should, the president, I believe, very smartly should restrict trade to those countries until our people will be safe. Okay. President proposed a cut in payroll tax that may or may not come through, but they are looking to send individual checks to individual Americans within the next week or two. We're going to start to get some financial stimulus out that are going to help people weather the storm for those people who lost hours or even jobs due to the shutdown of restaurants and those kind of things. So that's coming. Also, the SBA is offering very, very low interest loans to businesses, basically 0% interest. You can borrow directly from the government. You don't even have to go to a bank. So those industries that are affected by the outbreak will be able to keep making payroll, keeping people on and riding through this 2 or 3 weeks that we're going to have to do this. That's it, 2 or 3 weeks, guys. And then healthcare companies are waiving copays related to care for the virus, so people will go get seen and get treated and not spread this virus because they didn't have the money to make a copay, okay? So now what should we do? You guys have heard this 100 times, but if you're an at-risk person, avoid public places for now. The interesting news that came out today was that the #1 age group that are actually carriers of the virus are not the elderly. They are people, millennials, 20s and 30-year-olds. And this is one of the reasons why they did so much shutting down of the places that millennials like to hang out in. Bars, restaurants, movie theaters, gyms. They did a lot of these things because even though for most millennials, by far more than 99%, the virus would not be a major impact at all, you're going to take that home to parents and grandparents. It's going to spread. And we're trying to protect the more vulnerable parts of our population. So, you know, millennials, you're going to have to figure out something else to do with your weeknights for 2 or 3 weeks. After it's over, things are going to go right back to normal just like they were. Okay? Please practice good hygiene. I can't believe we have to tell people to please wash your hands, but do it a lot. If you're not feeling well or you have symptoms, stay at home, isolate yourself as best you can, and go get checked. They're going to do it for free, and they're going to treat you if they're going to give you medical care if you are affected. Okay. Most of all, though, guys, don't panic. There is no reason to panic buy toilet paper or groceries. Every CEO of every major grocery chain in America has said publicly, we have plenty of product. America makes more food in a year than we could ever possibly eat. There's plenty of toilet paper. They have to get it to the stores. And when you wipe out a store, it may take a week of staffers working full time to restock those stores. So they're closing for a few hours a night to give the employees a chance to restock. But there is plenty of stock. Do not hoard for months. You're not going to be locked up for months, first of all. But also, guys, get enough stuff for a week or 2 weeks. We don't need to hoard. Big, big, big thing. Please don't. Also, please don't make any sudden changes to your investments, whether you're my client or not. Do not make emotional mistakes while the rubber band is stretched one way or the other. Make logical and sensible changes if you do. So here's what we're doing for you if you're one of our clients. Your accounts are being rebalanced regularly now to take advantage of good stock prices. Rebalancing just means that if you were, for example, a person that should be 50% in stocks and 50% in safer things, right now, because of the stock market drop, you might only be showing 40% in stocks, and we now got 60% in safe stuff. What we do with rebalancing is we would reshift those percentages back to the original percentages of 50-50, which means we would scrape some off the safe stuff and put it back in stocks now while they're very cheap. So we're doing a lot of rebalancing for you. There are some client accounts that are taxable accounts, not retirement accounts, but things like trust funds or just regular brokerage accounts, that there may be some sense to sell something while it's down on purpose to lock in the loss from that investment, because you can write investment losses off your taxes. So we're doing what we call tax loss harvesting for several of our clients. And I am watching for changes in the economy, less so than the markets, that would affect your accounts for longer than a few weeks or a few months. And we'll make changes as we need to for those, okay? We are also making sure that no client has excess cash sitting in their account when we could be investing it now while stocks are so cheap. So that's what we're doing. Guys, I know it's hard to deal with something like this. They don't come very often, but they do come. Just please remember something. This will really help. As you look at your account today or tomorrow or the next week, please remember something. Your account balance is purely theoretical. And by that, I mean this. When you look at your account right now, it will tell you if you sell everything in this account for cash right now, this is what it's worth. But if you don't sell it, that number is meaningless. The only time you turn that theoretical number into a real one is if you sell. So don't sell if you don't have to. It's really important. I use the example of a house to give you an illustration of why this is irrational. Because buying stocks or any investments is sort of like buying a house. A home is an investment. You live in it, but it's still an investment that it will grow in value over time. So let's imagine instead of the stock market, you heard that over in China, there was this new strain of termite that could affect a few houses, and it may spread around the world, and it'll nibble on a few of your pieces of lumber in your home. And for some people who get it, though, the termites will successfully eat the house all the way to the ground. Okay, that's essentially what we're talking about with this virus, and we're dealing with it, making an allegory. Now, so in that case, let's say that people say, "Ooh, I'm not sure that this is the right time to buy a house." So the housing market prices fall by 20 or 25%. Now, if you are a homeowner and you hear the news that house prices have fallen right now 25%, while we do battle with a new strain of termite that eats about 1% of the houses it infects, and it's only going to infect a few people, but we're going to really lock it down to make sure that we contain this termite so that it doesn't spread to every house in America. We're just going to try to keep it to where it is. So everybody buckle down and let's not panic, but let's just know. No sane homeowner in America would say, "Oh my God, house prices are down. I have to sell my house right now." And that's what people do with stocks. I think the difference is truly that because stocks are priced second by second, every second of every day, you can see what your account value is. That's not true of other investments like your house. Your home value really is only ever valued when you're in the market to sell it. So I think that's the biggest difference. But guys, think of your stocks, your long-term investments, like you would a house. You would never sell your house because house prices are down because of the fear that you might get a termite. And that's something that you have to keep in mind, okay? So my general recommendations to our clients, not to the viewing public right now, is do nothing right now, okay? We need to let the rubber band snap back. We need to revert to the mean before we take action for most of our clients, okay? If you have the funds available and you are not living on your retirement or your investments, but you're saving for the future, this is maybe once in a generation, the best time possibly to invest. Literally every stock in the world is on sale, okay? If you are living on your investments now because you're retired or for whatever reason, it might be a good idea to just try to limit or stop any withdrawals for a month, maybe, while the markets are correcting, okay? If you can do that, great, do that. Please remember also there have been many, many times over the last just 10 or 15 years that we've had a killer virus that we were worried about, or that we've had economic and things that we were concerned about. This is not a financial crisis like the last recession. This is a health crisis. The financial system is doing great, okay? Now, once this thing is over, sit down with your financial advisor, and if it's not me, it should be. That's my shameless plug. Let's review your risk tolerance before there's a next correction. If you say to me, the last one, I don't know that I could ever do that again, Jeremy, honestly, then it's a good time for us to review your risk tolerance and scale things back after it's recovered, but not before, okay? Also, clients, please continue to stay in touch with me. In January, when we do our annual client review meetings, the market was at an all-time high. That usually means that my number of people that want annual review meetings is at an all-time low. I've noticed that over the 12 years I've been an advisor. When things are going good, you guys ignore my emails. Nobody schedules appointments. It's hard for me to get you in. When things are choppy and scary, you can't get enough of me, which is great. But stay in touch with your financial advisor, whether that's me or not, throughout the year, not just when things get sketchy. Okay, that's very, very important. All right. And I want to say thank you to our clients at Invest Advisors. I know I've been communicating with you like crazy. You've been getting text messages, emails. We've been doing these kind of live Q&As. With very few exceptions, there has been no panic. Unbelievable. You guys handle this just well. Every day, you guys are troopers. It's amazing. There has also been no selling of stocks. We were doing the strategy that we implemented for you. Everybody has been fantastic, okay? There's been no getting out. Nobody is jumping ship. You've all done great. Thank you very much. Now, this was originally a live Q&A. It can't be done now because we're recording it. But please, if you have questions, I offer my time, even to non-clients. You can schedule a 15-minute phone call with me. Go to my calendar, which is calendly.com/investadvisors. You can also find it in my email signature if you've gotten an email from me. And schedule some follow-up time. That's good for clients or prospective clients, just a member of the general public. Schedule a 15-minute phone call with me, and I'm more than happy to go over any specific questions, okay? I want to thank you guys very much for watching. If you have questions, this is going to be posted on Facebook. Please feel free to message the Facebook page. Please also feel free to put a general question in the comments below the video. And for our clients, reach out to me. Text me, call me, email me, whatever you need to do to get your questions answered. God bless you all. There is light at the end of the tunnel, guys. We're going to do great. Have a great day.